So we've got chapter 6. We're going to start here. How was it last week, guys? Is it kind of making sense? Everything we're doing so far? It's clicking? Clicking is a good thing. This chapter talks about variable costing. And we're trying to compare variable costing to absorption costing. But this is more of a tool for when there's a department or a specific segment of the company they're trying to decide if they dispose of or keep going. So what we're going to talk about today is variable costing in contrast to absorption costing. We're going to, those are some assumptions here, look at the difference. So variable costing is taking product costs to be the direct materials, direct labor, and variable manufacturing overhead. That's it. The period cost we're used to is the fixed selling and variable selling and admin. But in variable costing, we're adding the fixed manufacturing overhead into our period costs. We're familiar with absorption costing, where the only period cost we're familiar with is the variable selling and the fixed selling and admin. Variable and fixed selling and admin. Product costs include direct materials, direct labor, and all manufacturing overhead. But in this chapter, as we look at variable costing, the fixed manufacturing overhead we're going to put into the period cost. So our first question for you, which method will produce the highest values for work in process and finished goods inventory? Well, guys, absorption costing actually would, because part of the product cost is fixed manufacturing overhead, which is a big piece. Okay. Now, here we're going to look at Harvey. Harvey produces a single product. We've got 25,000 units that are annually produced. And we have it broken down, the variable costs per unit, and then we've got the fixed cost per unit. So we've got our variable cost, direct materials, direct labor, variable manufacturing overhead, and the variable selling and admin expenses. Then we've got our fixed costs. So unit product costs are determined in absorption costing. All the direct materials, direct labor, and factory overhead all get included in the unit cost. But in variable costing, only the variable production costs get included in the product cost. So you see in this example, the fixed manufacturing overhead is part of period cost. That is not going to be included in our product cost. Ida Company produces a handcrafted musical instrument called a gamelan that's similar to a xylophone. Gamelans are sold for $850. Selected data for the company's operations last year followed. So we don't show any beginning inventory. We've got 250 units that were produced. 225 of them were sold. As a result, our ending finished goods inventory is sitting at 25. We've got our variable cost per unit, direct materials, direct labor, variable manufacturing overhead, and variable selling and admin. And then we've got our fixed cost. Assume the company uses absorption costing compute the unit product cost for 1 gamelin? Well, in this case, we're going to take direct materials, direct labor, the variable manufacturing overhead, and then the fixed manufacturing overhead we divide by the number we produced of 250 units to come up with the cost using absorption costing is going to be $700 per product, per unit. But if we use variable costing, do you see how much lower it is? It's just $460. The selling and admin expenses are not treated as product costs under either method. These expenses will always be treated as period costs and charged against the current revenues. So the only variable direct product costs are the variable materials, the direct materials labor, the variable manufacturing overhead. Any selling will always be a period cost under each method. Now, to prepare income statements using the absorption method versus the variable, let's assume Harvey had 20,000 units that were sold during the year at a price of $30 each without any beginning inventory. Let's try to use both the absorption costing method and the variable costing method to create income statements. You see here, under variable cost, we show our sales, 20,000 at $30 a piece is our 600,000 in sales, and that's going to be no matter which method we use. Our variable expenses, our variable cost of goods sold at the $10, because that's what we came up with earlier, is our 200,000. Our variable selling and admin is the 60,000. Now we're putting that in our variable expenses to get to our contribution margin, but it's not part of our product cost, the variable selling and admin. Our sales minus those variable expenses give us our contribution margin of 340,000. Remember that contribution margin is what's left to pay our fixed expenses. So our fixed manufacturing overhead and our fixed selling and admin total are 250,000, giving us a net operating income here of 90,000. It's the difference between variable and absorption, it's the format. We're just, what we show as product cost is going to be very different. $10 per unit versus 16 per unit. Here, absorption costing, you see that we are using sorry, I don't know why I'm beeping. In this case, under absorption costing, we use not just the variable manufacturing overhead, but we also use the fixed manufacturing overhead as a part of our product cost. So that's why this is at $16 a unit. Our sales minus our cost of goods sold gives us our gross margin. Then we have our variable and fixed selling and admin expenses to come up with our net operating income. Do you see here that our net operating income under absorption costing is higher than under variable costing? And that's because, let me try to find it here. That's because under variable costing, all of our fixed manufacturing overhead is part of our period cost. But under absorption costing, our fixed overhead is put into product costs. Well, if we didn't sell all those goods, we've got some sitting in our ending inventory. So some of that fixed manufacturing overhead is sitting in the balance sheet. Hence why our net operating income is $30,000 higher under the absorption method than the variable method. Does that make sense, guys? Okay. Now, refer to the data in exercise 6.1 for IDA. The absorption costing income statement prepared by the company's accountant shows the information here. Under absorption costing, how much fixed manufacturing overhead cost is included in the company's inventory at the end of the year? So let's see here, data. So here we've got our, under absorption, we've got our sales of $191,250, our cost of goods sold of $157,500, with our gross margin, selling, and admin. If our fixed manufacturing overhead cost is 25 units sitting in ending inventory, guys, I don't know what is going on with this computer. Oh, I think I had my other computer hanging on it. I have too many computers up here. So if we had 2,500 units sitting in ending inventory, and if the fixed overhead was $60,000, remember, under absorption costing, we allocate that fixed overhead to all the products. So that 60,000 divided by 250 units that were produced gives $240 per unit is being allocated for fixed overhead. If we have 25 units sitting on hand at the end of the period at $240 per unit, that's $6,000 that's sitting in ending inventory of the fixed manufacturing overhead. Does that make sense, guys? That's why the numbers are off. Using an income statement for last year, using variable costing, explain the difference in net operating income between the two methods. Again, our sales are going to be the same, but in this method, under variable costing, our fixed manufacturing overhead is going to be written off as a period cost. So we're going to write off that entire $60,000. So under this variable costing method, our net income is going to be lower, sitting at $3,250, where here we were sitting at $9,250. Under absorption, remember the key is some of that fixed overhead is sitting in ending inventory. Under variable, all that fixed overhead is sitting under variable, it's all sitting as a period cost. The difference in net operating income between variable and absorption can be explained by the deferral of the fixed manufacturing overhead cost in inventory of that $6,000. Now, we're going to look at the two methods and then come up with why those numbers are different. So here you see, under absorption costing, we've got the manufacturing expenses that were put into cost of goods sold are at 120, but that's still sitting in inventory, ending inventory is at 30. So we've got $150,000 of fixed manufacturing expenses that are earmarked, 120 of it in the income statement, 30 of it in the balance sheet because those goods hadn't sold yet. When we deal with variable costing, that entire amount is a period cost. So all of it is subtracted to arrive at our net income in the income statement. So that 30,000 that's sitting in the balance sheet, we don't take into account when we're dealing with variable costing. It all gets expensed. Hence why there's a difference there. Make sense, guys? So under variable costing, we've got net income of 90. Under absorption costing, we have net income of 120. The difference is that 30,000 sitting in ending inventory. Okay? Here in year 2, we've got 25,000 units produced, but in this year we sold all of them. We sold the 30,000. So we had some units in the beginning inventory. In this case, our absorption costing is going to be a lower net income than our variable costing is going to be, just because we sold more units than what we really even produced in this period. So in this case, in year 2, under variable costing, we're going to have better net income than we're going to show under absorption costing. So you see here, since the variable cost per unit, total fixed cost, and the number of units produced remained unchanged, the unit cost computations remain unchanged. Under variable costing, all the fixed overhead was put as a period cost. Under absorption costing, we add those fixed costs to our product costs. Okay? Once that extra 30,000 is then released from inventory, it's going to be part of the income statement. So you see here, again, that difference in variable costing, we've got a higher net income in that second year. Absorption costing is lower because those fixed costs are flowing with the goods. So in year 1, the variable costing net income was lower. But in year 2, under the variable costing method, it was higher because we sold more than we actually produced. Ultimately, guys, it's all going to flow. It's all the same over a 2-year span. It's just between the years it will vary. No, if the units produced are the same as the units sold, nothing's going to change. The variable costing versus the absorption costing isn't going to matter. If the units produced are greater than the units sold, then the absorption income is going to be greater than the variable income. But if units produced are less than the units sold, which was that example in year 2, then absorption costing is going to be less than our variable costing. Okay? Variable costing categorizes costs as variable and fixed, so it's much easier to use this income statement format for the CVP analysis that we were talking about. Because absorption costing assigns fixed manufacturing overhead costs to unit products, units that got produced during the year, A portion of fixed manufacturing overhead still sits in our ending inventory on the balance sheet. It won't flow through the income statement until those units are actually sold. Variable costing income is only affected by changes in unit sales. It's not affected by the number of units produced. When sales go up, net operating income goes up under variable costing. Okay? Let's look at this thing here. Jorgensen Lighting manufactures heavy-duty street lighting systems for municipalities. The company uses variable costing for internal management reports and absorption costing for external reports to shareholders, creditors, and the government. The company has the following information. So we have 3 years. We've got our beginning inventory and our ending inventory and our variable costing net operating income. And it tells us here that the company's fixed manufacturing overhead per unit was $560 for all 3 years. So it's given us a flat amount each year. Calculate each year's absorption costing net operating income. Present your answer in the form of a reconciliation report. Okay, so these are our variable net operating income. They want us to take this information and figure out what the absorption costing would be. And they gave us here that the fixed manufacturing overhead per unit sitting at $560. So if we start year 1, we started the year with 200 units. We ended with 170 units. So we're in the hole minus 30. We used up more than what we produced. Our fixed manufacturing overhead, if we're sitting at $560 per unit, sitting in ending inventory, we take our 170 units at that 560, or in year 2, the 180 times 560, or the 220 times 560, we get our ending fixed manufacturing overhead. Then if you subtract the beginning inventory from each of these, you get a deficit or a plus that was deferred. So for example, in year 1, we started the year with more than we ended the year. So we basically we sold more inventory than what we produced. So in that case, we're going to show under absorption costing a lower net income than our variable costing. However, in year 2 and in year 3, because we produced more than we actually sold, we produced more than we actually sold, we're going to have a greater net income using the absorption method because that fixed piece is sitting in finished goods in the income statement. So basically, over time, these figures all even out. They use this variable costing to help make for decision-making tools. But the goal on these problems is to understand how you can reconcile the variable costing method to the absorption costing method. Knowing absorption costing takes into account all all overhead, manufacturing overhead, be it variable or fixed, they get put into product costs. Now, assume in year 4 that the company's variable costing net operating income is $984,400 and its absorption costing net operating income is $1,012,400. So the variable is going to be lower than the absorption. Did inventories increase or decrease during year 4? How much fixed manufacturing overhead was deferred or released? Here, if the absorption costing is greater than the variable costing, then that means we produced more than we sold. Inventories must have increased during the year, and hence fixed manufacturing overhead was deferred in inventory. So basically, no, under absorption, the fixed overhead follows the products. So if the variable is less than the absorption costing net income, then it shows we didn't sell all that we produced. So you can see our ending inventory is greater than what our beginning inventory was. Prepare a segmented statement. Now, this can be a division, a specific store, however you want to separate out what you're trying to report on. A segment is any part of an activity of an organization which they want to gather information on. A contribution format should be used because it separates fixed from variable costs and it enables the calculation of what we call contribution margin. Remember, contribution margin is all that is we have to apply to fixed expenses. Traceable fixed costs should be separated from common fixed costs to enable the calculation of that segment margin. And here, traceable fixed costs in this example can be the salary of the product manager, because that's going to be traceable to the Fritos division. The maintenance costs for building in which the 747s are assembled can be a traceable fixed cost just for the 747 segment. So depending on what segment we're wanting to look at, we need to separate those costs specifically associated with that segment. Common fixed costs aren't going to go away because we get rid of a segment. So common costs arrive because the overall operation wouldn't disappear if any specific particular segment gets eliminated. So the salary of the CEO of General Motors is going to be a common cost. So it's not going away just because we close off a certain division of General Motors. As you see here, the cost of heating a grocery store is a common cost. And if we eliminate a various department, that common cost is still going to be there. So it's not really applicable to the big picture here. It's important to note that traceable fixed costs of one segment could possibly be a common fixed cost of another segment. The landing fee paid to land an airplane at an airport is traceable to a particular flight, but it's not traceable if we're talking about first class or business class or economy class. That's going to be a common expense if we're trying to compare the different categories of passengers. But it is a common, a traceable cost as it pertains to that flight in general as a whole. The segment margin is computed by subtracting the traceable fixed cost of a segment from its contribution margin. Ultimately, that's a way to separate that specific segment of a business and look at the potential of how it's going to uphold, be profitable. Fixed costs can be traceable or common. The common cost can't be allocated to a specific segment because it's not going to change if we got rid of that segment. That common cost isn't going to go away. So therefore, it shouldn't be part of the equation. So we've got this company, Weber. They've got a computer division and a television division. We're going to focus here on the television division. Here you see the sales from the television division, the variable cost of goods sold. Then we've got some other variable expenses to come up with our contribution margin. We take from this segmented income statement, the traceable fixed cost in order for us to see what kind of profit this specific segment is bringing in. So again, we're using that contribution format, which basically shows after the variable expenses what gets applied to the fixed expenses. And the segment margin in this case is what this specific division benefits for the whole company. Now, here's the key though. The company as a whole is going to have some common expenses that the separate divisions don't necessarily have to add. So even though in this case the television division is bringing in 60 and the computer division is bringing in 40, they're not necessarily taking into account all the costs because those costs are for the whole anyway. So you see here, this purpose here is to come up with the division margins for each of the different segments. Fixed expenses that are traceable to one segment can become common fixed expenses if the company is divided into smaller segments. So Weber's got this television line. Now we're going to break down how much is profitable for the regular television division and how much is the margin is for the big screen. So in this particular segment of television, we're now breaking it down even farther to break down how much profit is being made on the regular TVs versus the big screen TVs. So again, as we break down by segment, we might not be including some of the common expenses because those common expenses really shouldn't be part of those separate segments, as in this example. Those common expenses aren't traceable per se for the regular versus the big screen. Fixed costs directly traced to the television division, they could trace 45 for the regular TVs, 35 for the big screen. Those are traceable, but these common expenses you keep out of the segment operating incomes. So why are we doing all this? Ultimately, all of this is used so management has more tools to help make better decisions. That's the whole purpose, actually, of understanding how managerial accounting works, is so this information can be provided to those internal users, the managers, to help make decisions. Here, when we've got this information, we've got the television division broken down into the regular and the big screens. So now they can do some manipulation of data and think, okay, if we can increase our sales by 5% overall, if we can increase our sales by 5%, then what happens with everything else? So in this example here, we had a divisional margin of 60,000, and we had a product line margin here of 70. By increasing our sales by 5%, that ups our income as a whole 15,000. And then by upping the income as a whole by 50,000, it then increases for the regular television. The margin went up $5,250, but the big screen only increased it by $2,250. Okay, so basically, in getting this information and breaking them down more, it just allows what if scenarios. If we could increase our sales by 5% by having 5,000 more in advertising, is it worth it? In this case, it is worth it because our division margin went up 2,500. Okay? Completing contribution formats. And this one, Royal Lawn Care produces and sells 2 packaged products, Weed Ban and Green Grow. Revenue and cost information is shown below. Last year, the company produced and sold 15,000 units of Weed Ban and 28,000 units of Green Grow. Its annual common fixed expenses are 33,000. So we basically can take this and show our sales broken down by Weed Ban and Green Grow and our total, then our variable expenses, showing our traced fixed expenses. And you see here the Green Grow, their margin for this department is at 42,000, where Weed Ban's is at 9,000. We've got the sales showing here and the variable expenses showing here. Well, you can see their variable expenses for Green Grow is sitting at $525 per unit, where the Weed Ban is sitting at $240 per unit. Granted, Green Grow's selling for a little greater price, but overall, the contribution margin isn't as beneficial. So do you see how it benefits them to make decisions on breaking down these segments to see where their profits are truly coming from? Now, moving on to look at some break-even points. Here, we've got back that division again, and the company with the 2 different television segment and computer segment. Now, what is the company-wide break-even point? So the company-wide break-even point, we'd see the contribution margin ratio is the 270,000 divided by 500,000. So our contribution margin here, 270 divided by the 500,000 gives us 54% contribution margin ratio. If we have fixed expenses of the 170 and the 25, let me just make sure I'm putting this right. If we have our fixed expenses of the 195,000 and we divide that by our ratio, we know what our sales need to be, right? Or what we need to earn in order to cover the fixed expenses. So here we can then do it by each unit or each segment. We can take our contribution margin ratio by each segment and then figuring out those traceable fixed expenses in order to break even by each of those segments. So the 25,000 common fixed expenses aren't part of the break even for those individual segments, okay, since they're not traceable back to those segments. Cost assigned to a segment should include all costs attributable to that segment. So things related to research and development, design, marketing, manufacturing, customer service should all be part of that. Common cost, of course, shouldn't be allocated to segments. Oftentimes people think it's got to be covered somehow, but it basically, if you can't trace those costs to that segment, it's not applicable in determining if it can be profitable. When companies try to allocate common costs, it makes managers responsible for things they have no control over. Ultimately, it's really not fair. It happens all the time, but it's truly not fair for a manager to be responsible for costs he can't even control at all. Here we've got Hoagland's Lakeshore has a bar segment and has a restaurant segment. So you see here we have it totaled and we have it broken down by the bar and the segment. Now, the common costs that were not taken into account are these 200,000 common expenses because they aren't traceable to either one of those divisions. How much of the common fixed expense of 200,000 can be avoided by eliminating the bar? Can any of it? No. Remember, the whole purpose of these common costs is if one part gets dropped, those costs are still here no matter what. Suppose square feet is used as the basis for allocating the common fixed expense of the 200,000. How much would be allocated to the bar if the bar occupies 1,000 square feet and the restaurant occupies 9,000 square feet? Well, yeah, in that case, 10% of those costs would be aligned to the bar. If Hoagland allocates its common fixed expenses to the bar and the restaurant, what would be the reported profit of each segment? Well, look at that. The restaurant is sitting at a profit there of 50, but the bar's in the hole already. Do you see? It's not really applicable. You still need the bar. So it's showing as though this bar is not profitable, where in fact it is. Do you think the bar should be eliminated? No. The profit was 44,000 before eliminating the bar. If we eliminate the bar, the profit drops even more. That's why you have to be careful what you assign to those specific segments. Remember, all of these tools are used for internal purposes, for management to make better decisions. Generally accepted accounting principles are for external financial statement purposes and require absorption costing. So because it's required externally, most companies use it internally rather than taking the time to come up with various other formats of helping to make decisions, such as this variable costing. Variable versus absorption costing. Under absorption costing, fixed manufacturing costs are assigned to products. Under variable costing, those fixed manufacturing costs are part of the period costs, since they're looked at as capacity costs, and they're saying they're going to happen no matter what. Even if you didn't produce anything, they're going to occur no matter what. So the variable costs get assigned as period costs. Companies must report segmented results to shareholders using the same methods that are used for internal segmented reports. This requirement motivates managers to avoid using the contribution approach for internal reporting, because if they did it, they'd have to share all that information with the shareholders. Let's look at how we calculate the break-even here. We've got Piedmont has a North Division and a South Division. And here's their segmented income statement. First, we're going to compute the company-wide break-even point in dollar sales. So you see our contribution margin is at 240,000. Our sales is sitting at 600. 240, divide that by 600, will give us our ratio, 40%, and our fixed expenses are our 120 plus our 50, or 170. So 170,000 divided by 40% means our sales need to be 425,000 just to break even. Okay? For the North region, if we compute the margin for and look at their traceable costs of 60,000, we've got to have sales of 200,000 just to break even. For the South region, we would need to have sales of 100,000 just to break even. So basically, what we're doing is seeing as a whole what the break even is, and then per division. Here we've got a consulting company, and they're breaking it down by location. They have a Chicago location and a Minneapolis location. Here they want us to figure out break-even points, see what ifs. What would happen if Minneapolis increased its sales and nothing else changed. So again, to come up with break even, we come up with those fixed costs, divide it by the ratio to figure out what the sales need to be in order to break even. Then you can do it by each division. How much would the company's net operating income increase if Minneapolis increased its sales by $70,000 per year? $70,000 times the Minneapolis's contribution margin would show a $30,000 increase for fixed expenses in Minneapolis, because the fixed cost in the office and the whole won't change. The entire $30,000 would be going towards net operating income. Okay. And then prepare new segmented income statements using an increase. Chicago sales are going to increase 50,000 next year, with Minneapolis's not changing. So you see how the break it plays out here. Okay, let's take some time here and let's look at some problems. Any questions here? Yes, no? Nope, wrong book. Okay. Excuse me 1 second. I apologize, guys. I'm gonna. Okay, sorry about that. Okay, let's look at a problem. That's not right. There it goes. Okay. Haas Company manufactures and sells one product. The following information pertains to each of the company's first 3 years of operation. So we see the direct materials, direct labor, variable manufacturing overhead, variable selling, and then the fixed. During its first year of operations, Haas produced 60,000 units and sold 60,000 units. During its second year of operations, it produced 75,000 units and sold 50,000 units. In its third year, Haas produced 40,000 units and sold 65,000 units. The selling price of the company's product is $58 per unit. Calculate the break-even point in unit sales, and then assume the company uses variable costing. Compute the unit product cost for year 1, year 2, and year 3. Prepare an income statement, and then assuming the company uses absorption costing, compute the unit cost in year 1, year 2, and year 3. So if we look here, for the break-even point in unit sales, we've got here break even in unit sales. What we'll need to do is figure out, we're selling the unit for how much? $58. We're selling the unit. Our variable costs are the 20 plus the 12 plus the 4, right? 20 plus 12 plus 4 and the variable selling of 2. So here, let's just look down here. If we're selling it for 58 bucks, the variable costs are 38, okay? So we've got a contribution margin here of $20 per unit, right? If our fixed costs are the $960 plus the $240, right? So the $960 and the $240, we're talking about $1,200. $1,200 divided by 20 bucks per unit means we've got to sell 60,000 units just to break even, right? Make sense? So what's the break-even unit in sales? 60,000 units. Requirement 2, compute the unit product cost for year 1, 2, and 3 using variable costing. So remember, using variable costing, we're not going to do anything with our fixed overhead. The product cost For years 1, we've got the 20 plus the 12 plus just your variable manufacturing overhead. So for each year, our variable costing unit product costs are all going to stay the same. 36 bucks. Okay? For the next requirement, now they want us to prepare an income statement using variable costing. It says in year 1, Haas, during its first year, Haas produced 60,000 units and sold 60,000 units. So we show the sales of 60,000 units times 58, was it? Let's just see. 50,000 units, or 60,000 units times 58 is going to give us our 3,480,000 in sales. In year 2, it said it sold 50,000 units, and then it sold in year 3 65,000 units. So the sales is all going to be related to the figures they gave us at 58 bucks. The variable cost of goods sold will be, again, based on the figures they gave us times what was sold. So we've got here 20, 32, 36 bucks in variable costs times those respective costs. And then the variable selling and admin, I believe that was 2 bucks times the amount sold. After that, we show our contribution margin, our fixed manufacturing overhead, and the fixed selling was given to us, okay, 960 and 240, to come up with our net operating income under variable. Pretty straightforward. Next, it asks us, compute the compute the unit product cost for year 1 and 2 and 3. We did the income statement. Now compute the unit product cost assuming absorption costing. Now, so absorption costing, we're going to take into account the fixed. So we've got our 20, our direct labor, our variable manufacturing overhead, and the way we're going to calculate our fixed manufacturing overhead is they told us 960,000. In year 1, we manufactured 60,000 units. In year 2, we manufactured 75,000 units. And in year 3, did we only manufacture 40,000 units? Yep, it only produced 40,000. So we're just taking the amount of 960,000 in fixed each year divided by how many were produced to come up with how we will spread the fixed manufacturing overhead. So remember, under absorption costing, that fixed manufacturing is going to stay with some of the ending inventory until it's actually sold. So in year 1, if our cost of goods is 52 bucks, that would be our cost in year 1, our cost in year 2, and our cost in year 3, because that fixed is just divided by the amounts that were produced. Then here are our income statements using the absorption method. Okay? Make sense? You want to look at another one? Absolutely. Yeah, so that's kind of, yeah, we kind of went, I brought all that up. Maybe you didn't see it, but okay, you bet. Okie doke. Let's look at another one here. In this one, High Country produces and sells recreational products. Just opened a new plant to produce a folding camp cot. The following cost and revenue data relate to May. So we, starting with nothing, we produced 10,000 units and we sold 8,000 of the units. It's telling us what we're selling them for, and it's letting us know the variable cost and the flat 200,000 fixed monthly cost with our manufacturing, direct materials, direct labor, and the variable manufacturing overhead of manufacturing costs. Okay, assume the company uses absorption costing. Calculate the camp's COTS unit product cost. So we know we've got our direct materials, 20 plus 8 plus 2, and then we've got to come up with our fixed, the 100,000 divided by what we produced by 10,000 units. That would probably be $10 a unit, right? So you see here, under absorption, we take all the costs they gave us, but we've got to come up with our fixed manufacturing overhead divided by the number produced to let us know the absorption costing product unit. Unlike variable, absorption takes into account and allocates that fixed cost among the products. Okay, so that's $40. Next, prepare an income statement. It told us it produced more than it sold. It produced 10,000. It sold 8,000. Sold them for $75. Then the cost of goods sold would be that 8,000 times the $52, was it? Excuse me, the $40. And then we've got our selling and admin expenses to come up with our net operating income. Right there, dear? Now, if we use variable costing, our unit costs don't include that extra $10. Remember, the fixed manufacturing overhead is a period cost. So basically, it's just going to be the $30. So when we do our variable contribution margin, it's only going to show the variable cost of goods sold, the 8,000 units times the $30. We've got our variable expenses up here, and then the entire 100,000 is a period cost down below. Okay? Let's look at one more. I think we did something just like that on the PowerPoint. Okay, we'll go through this one. Millard Company is a wholesale distributor of office products. It purchases office products from manufacturers and distributes them in the West, Central, and East divisions. Each of these regions is about the same size, and each has its own manager and sales staff. The company's been experiencing losses for many months. In an effort to improve profits, the management's prepared a segmented income statement for May. So basically, we've got the different regions and the cost of goods sold and shipping expenses are both variable. All other costs are fixed. Prepare a new contribution format segmented income statement for May. So let's see, it's been experiencing losses. So what they want, sales region here, we've got the total. The West is at 450, the Central's at 800,000, the East is at 750. So we're showing a total with them broken down. The cost of goods sold are separated by each department, and the shipping expenses, they said, are variable. So the shipping, the 17.1, the 32,000, and the 28.5 are also going to be a variable expense before the contribution margin here. Okay? Then each department has to take their fixed expenses. So their traceable expenses for West, depreciation, utilities, salaries, advertising, salaries, utilities, advertising, depreciation, those are all their traceable fixed. Then the corporate expenses, the general and administrative, aren't going to be traced back. You know, they're common expenses. They're not going to get traced back. Okay? So I'll just put this up so you guys can get some help there. Okay, let's look at one more. Bracy company manufactures and sells one product. The following information. We've got our variable cost, the direct materials, our fixed cost, we've got our direct labor, fixed manufacturing overhead, and fixed selling. The company does not incur any variable manufacturing overhead cost or variable selling and admin expenses. During the first year of operations, Bracy produced 20,000 units and sold 18,000 units. It was sold $55 per unit. If the company uses super variable costing, compute the unit product cost for the year. So basically here, we're taking the direct materials of 19. The next, prepare an income statement for the year. Well, it told us what the sales were. It sold 18,000 units at $55 per unit. So the sales, and then our variable cost of $342 gives us our contribution margin. Then you show your fixed expenses here. Next, compute the unit product cost for the year, assume the company uses a variable costing system that assigns $12.50 of direct labor to each unit produced. So we've got our materials up here of 19. If we assign the $12.50, then our cost per unit is going to be at $31.50. If we do a contribution income statement, you'll see what we sold it for, the cost with our fixed costs here. Number 3, compute the unit cost. Assume the company uses absorption costing that assigns $12.50 of direct labor and $15 of fixed manufacturing overhead to each product. So guys, it's going to be the $12.50 plus the 15 plus our materials up here of 19 gives us our unit product cost. Then the contribution absorption costing income statement, the contribution format, the cost of goods sold here is going to include all those factors, and then minus your fixed expenses, which will only be your selling and admin on this one. Reconcile the difference between the variable costing methods. Let's go down here and show that the difference between them, the units in ending inventory will equal the units in beginning plus produced minus sold. Okay, so we've got 2,000 units left in year 1. Then you take those various costs to show that 25,000 was sitting direct labor deferred in inventory under the variable costing, and then the variable costing net income. So basically, here, let me just give you this. This helps you see how you can reconcile between the different methods. And then the variable to the absorption costing. We've got a lot more going into cost of goods sold because the fixed manufacturing overhead is part of the product cost instead of the period cost. Okay, this will help you there. Any questions, guys?